Okay, let's dive in. Welcome, everyone. Today we're doing a deep dive into some source material you sent over, focusing on a very specific market, Naperville, Illinois real estate.
That's right. And specifically, we're looking at investment opportunities there, particularly through the lens of non-traditional financing, things like hard money or private money loans.
Our goal here is really to unpack the insights from these sources. What makes Naperville tick for investors, why look there, and what strategies are highlighted for maybe maximizing returns using these different financing tools.
And there's definitely a hook in the material right away. This idea of Naperville being competitive, yes, but also full of opportunity. It even hints at 100% financing possibilities for experienced investors being discussed.
Intriguing stuff. So let's set the scene first, based on what these sources are telling us.
Okay. So the sources, they really frame Naperville as a, let's say, premier destination for both real estate investors and lenders. They talk about its market resilience and definite growth potential.
And they pinpoint its location, right? A Chicago suburb about 28 miles west. So it has that suburban feel, but also, crucially, that metro train access into the city.
Exactly, which is huge for commuters under an hour into downtown Chicago. That blend is key.
Now, digging into the market performance details from the sources, competitiveness is a big theme.
A very big theme. It's called out as one of the most competitive markets in the entire Midwest, actually.
Wow. And they back that up with a specific number. Days on market. Properties apparently average just 30 to 45 days on the market there.
Which is incredibly fast. That kind of turnover, it signals really strong buyer demand, obviously.
But for investors using certain kinds of loans, it also means quicker turnarounds are possible, right?
Precisely. And it also highlights a potential problem with traditional financing, as the material points out.
Yeah, if a house is gone in 30, maybe 40 days, waiting 60 days or more for a conventional bank loan, well, you're probably going to miss out.
Right. And that's where the appeal of alternative financing, like hard money loans, comes in. The sources stress the speed factor, getting the funds quickly to secure a property.
And just to clarify for anyone listening, hard money loans are typically those shorter-term loans, not from a bank, based more on the property's value than, say, your credit score alone.
Correct. They bridge that gap when speed is essential. Now, connecting that speed to returns, the sources emphasize Naperville's appreciation rates.
Ah, yes. They mention it consistently outperforms national averages.
Yeah, we're talking annual appreciation rates somewhere in the 4 to 6% range consistently.
That's pretty solid. And that steady appreciation, it helps everyone, doesn't it? For the lender, especially an asset-based lender like a hard money provider, the property value is their security, so appreciation adds a cushion.
Exactly. The loan-to-value ratio gets better over time. And for the investor, well, it's building equity, building wealth potential. It's fundamental.
And the sources link this appreciation directly to certain investment plays being viable there.
They do. They suggest it really supports fix and flip projects naturally, but also buy and hold rental strategies, some new construction, and even bridge financing needs.
Okay, let's pivot slightly to the rental market. The sources describe that as pretty strong, too.
Robust is the word they use. And they give numbers. Average monthly rents between $1,800 and $2,500 for single-family homes.
And for apartments.
Lower, around $1,200 to $1,800 a month.
And the takeaway from the sources is that those kinds of rent levels suggest good potential for positive cash flow, which is, of course, vital if you're financing a rental property.
Definitely. But, beyond just the numbers, the appreciation, the rents, the material, also digs into why Naperville is so attractive, the underlying factors. They call them the hidden gem factors.
Okay, let's unpack those. Location seems like a big one, right? We mentioned the 28 miles west of Chicago, the Metro.
Critical. The sources explain this isn't just convenient, it directly fuels demand. You get city commuters, families wanting that suburban lifestyle but needing easy job access.
And that consistent demand underpins property values and rental strength.
That's the connection the sources make, yes. It supports the exit strategies for investors using private or hard money.
Then there's the economy. The sources use terms like economic powerhouse.
Yeah, and they list some impressive figures to back it up. Median household income around $125,926.
Wow, that's nearly double the national average.
It is. Plus major employers like Edward Hospital, BP America, Nokia. There's a thriving tech corridor mentioned.
And low unemployment compared to state and national levels.
Consistently lower, yes. And the sources tie this strong economy directly to investment success. Think about fix and flips.
Right. In a strong economy with high incomes, finding buyers for renovated properties should be quicker and easier.
Exactly. which is crucial when you're working with shorter-term financing, like a hard money loan. You need that efficient exit.
Education comes up next as a major draw.
Oh, absolutely. The sources specifically name-check the school districts: Naperville Community Unit School District 203 and Indian Prairie School District 204. They're consistently ranked among the best in Illinois.
And the impact on real estate. The sources say it drives sustained demand from families, right?
Sustained demand supports higher rents in those school zones, contributes to faster appreciation, and usually means lower vacancy rates. It makes properties there very attractive assets, both to own and to lend against.
Population growth is another factor mentioned, over 149,000 people, and apparently still growing.
And that growth creates demand for new housing, demand for renovated properties. The sources suggest this fuels opportunities suited for that faster-moving hard money financing.
Makes it. Finally, they talk about quality of life.
Yeah, kind of the icing on the cake. They point to things like Money Magazine rankings, over 2,400 acres of parks and preserves, the Riverwalk, the downtown area, low crime.
All the lifestyle factors that make people want to live there.
Exactly. And according to the sources, this helps properties hold their appeal for renters and buyers alike. It provides a certain stability, which is reassuring for both investors and their lenders. You feel confident about the exit.
Okay, so putting that foundation in place, let's look at the specific strategies the sources say investors are using there, often with this non-bank financing.
Right. They outline a few common approaches. First up is fix and flip.
Focusing on older homes, maybe near downtown or in established areas, needing updates.
That seems to be the sweet spot mentioned. And the sources really stress the financing link here. Quick approval hard money loans are often essential to grab those opportunities fast and get the rehab done within that, say, 6 to 12-month loan window.
Makes sense in a competitive market. What about buy and hold rentals?
The sources suggest targeting properties near North Central College or within those top school districts we talked about, aiming for a strong, consistent rental income.
And the financing angle there.
Often, the material notes an investor might use hard money for the speed of acquisition and maybe the initial renovation funds. Then, once the property is fixed up, rented out, and stabilized, they look to refinance into a traditional long-term mortgage.
Okay, so using hard money as a bridge, essentially.
Precisely. And lastly, new construction gets a mention.
Though maybe less common because land is tight.
Seems so. But where land is available, the sources suggest these projects can be quite profitable and often financed by commercial hard money lenders who recognize the strength of the market, the demand, the appreciation potential, making it a solid asset to lend against.
So if we pull all this together, what's the overall conclusion from the source material about Naperville?
The bottom line presented is pretty clear. Naperville is seen as an exceptionally good fit, almost an ideal market for investors who know how to use alternative financing effectively.
And it's that combination of factors we discussed. The stable economy, the growth, the great schools, the quality of life.
Right. All those things create multiple reliable exit strategies for investors using hard money or private loans, whether they plan to sell quickly to a strong buyer pool or rent long-term to high-quality tenants.
So the sources really conclude that the fundamentals in Naperville strongly support profitable real estate investing, especially when paired with these non-traditional financing tools.
That's the clear message coming through, yes. The pieces fit together quite compellingly according to this material.
Wow. Okay, so it's really clear from this material you shared that Naperville isn't just, another suburb. It's got these specific potent ingredients, the fast market pace, solid appreciation, good rents, all backed by really strong fundamentals like the economy, schools, and quality of life.
Exactly. And crucially, the sources make that direct link between these market conditions and why alternative financing like hard money can be so effective there. It provides the speed and flexibility needed for flips, rentals, even some new builds in that kind of environment.
Yeah, it paints a picture of how those tools fit specific strategies in that specific market. Hopefully this deep dive gives you, the listener, a clearer view of the opportunities and characteristics highlighted in the sources you sent our way.
Absolutely. And maybe leaves you with a final thought to chew on, building on what we've discussed from the sources. In a market described as this fast-paced, this competitive, and with such high demand, even with all those strong fundamentals, what might be some of the really critical, maybe less obvious challenges or risks as an investor absolutely needs to anticipate and manage, especially when relying on that speed and asset value focus of alternative financing?